Hello and welcome to another episode of the SwingTrader Status Update. It's Justin Nielsen here, and it is June 4th, 2024, and I'm joined, as I am every week, by Mike Webster, our senior market strategist. How you doing, Mike?
Has it been a week?
It has been a week,
Man,
yes.
that was fast.
Yeah, it has moved. Yeah, well, especially after and it was kind of an interesting week, right? So let's dive right into it. I'm going to throw up the Nasdaq right now because this was really kind of crazy. What we saw here was on May 31st. This was quite a day. And Mike, you and I were talking in the middle of the day, and when I say the middle of the day, when the composite was way down here, and we were kind of looking at our market school rules and saying, well, gosh, if we close down here with heavier volume, assuming it was a distribution day, what would that do to our market exposure? And it was basically going to clobber it. But because we ended up reversing, having that upside reversal, getting the support at the 21-day moving average line, closing above it, there was no change. So talk about kind of like what a wild thing that was.
Yeah, that was about as difficult as it gets for swing trading, right? If you're position trading, think more like standard orthodox IBD trading or something like that leaderboard does, then you're making all your decisions kind of at the end of the day, at the end of the week. And it's different. But with swing trading, with having tight stops, action like that kind of kills you because it takes out so many of your stops. So there's multiple things that were going on that day that just make it really about as frustrating and challenging as swing trading gets. So let's take one thing at a time. We'll start with the market exposure and what you were talking about with market school. So market school was something, when did we come up with that? In 2011-ish?
That sounds about right.
Something like that. So you, myself, Charles Harris, we came together and we spent a ton of time doing original research, but blending in with Bill O'Neill's style of follow-through days and distribution to come up with black and white rules for how deep in the market to go. So an exposure count. And the exposure count, because I know most people listening or watching, don't know what market school is, but it basically ranges from 0, meaning to be out of the market, to a +5, which means you can go 100% in the market, to up to a +7, which what that does is not necessarily margin, but it gives you more wiggle room in case you have some sell signals in the market so you don't react right away and you still are allowed to be 100% in or really on margin. So coming into that day, we had been at 7, meaning we not only had the ability to be fully invested, but then some, basically having some wiggle room. And at the bottom of the day, what was it? It would have been a +1, right?
Yeah, from a 7 to a 1. That's
Which
very
is
unusual for you to get that kind of drastic change.
Yeah, and that's more like a crash type of thing. That now, obviously, that wasn't a crash, but that's how that was designed. But it was just triggering all these sell signals at the same time. So that was one thing that we were dealing with because we really trust the market school rules. It's something that we know that they're not perfect, but it is a good thing, good gauge for us to use because nothing is perfect of how deep in the market. So we came in heavy in the market. Which we should have been because we're in the middle of a power trend, which is also a concept that came out of those market school rules that the three of us developed. And so we came in heavy, and then all of a sudden you had this heavy selling that was going on in the first part of the day, and that was bringing us down to where we pretty much were going to have to only be about 30% invested at the end of the day to stay in line with those market school rules that we have. So going from 100 to 30 is pretty substantial. But what we were doing is just allowing our stops that we set up every day on each one of our stocks to just get us out. So we weren't really doing any additional selling. Almost all of the selling that we did was predetermined. So midday, so everyone knows behind the scenes, the three of us, Justin, myself, and and Dominic and Chris Gessel, when he's available, we get together and we go over every position and we say, okay, where are we going to trim it? Where are we going to add to it? And where are we going to eliminate the position? And that's something that everyone should be doing with your individual stocks and ETFs, regardless of your style, whether you're following SwingTrader, leaderboard, you're just doing your own thing. You always want to have a plan ahead of time because things like Friday happen. And so just one by one, it was just triggering those sell signals. And then before you knew it, we were only, we were in the 50% range invested, right?
Yeah.
Maybe 55 or so. And then we looked at it and said, wow, and you even made the comments, we've got to make sure that we don't go too light, which was really good, information, because at that point,
And that was probably in the, almost in the last hour and a half, would you say?
Mm-hmm.
Yeah.
I think so. It was after we had stopped going down, and then we were just looking at everything and you made that comment. And so we were then realizing that our market school count wasn't going to be at a 1. It was going to, if we closed where we closed, it was going to be unchanged at a +7. So that
I don't know that we realized that yet. I think we just were thinking it was, it was lower than it should be.
You're
that
right.
kind of a drastic change. What ended up happening is we put a number of things on, and then that's when the market almost immediately started turning. So,
well,
yes,
exactly. It was a wild day. You're remembering that correctly.
Yeah.
So at that point that we were in the 50+% invested, and you made that comment like we can't get too light, or we don't want to get too light. We were looking at everything, and then I switched gears from being defensive to going, wow, we've kind of, because of all of these things have triggered our stop losses. Let's look and see where else we can get some exposure if there was anything. And why don't we look at a couple of those things that we did decide to get into?
Yeah, we really went with a lot of ETFs, and one of the things we kept on gravitating towards as we were looking at stocks that were holding up, a number of insurance ones. Now we put Chubb on, ticker symbol CB, but there were a number of others that we were looking at, including what was it? HIG was another one. So, and again, remember this is on the 31st when, the 30th we saw the reversal here and a nice follow up on the 31st when everything else was kind of getting killed. That was HIG. Chubb, we I think already had on.
Yeah, I think we had it on earlier. So yeah, with that we decided, because of the
Brown and Brown,
because all of them were looking good, we just said, you know what, let's go with the ETF, because they kind of, insurance plays for the most part tend to be a kind of a group move. They either all go up or they all go down. There are some exceptions, but it's kind of like the home builders or oil and gas stocks. They tend to move together. So we went with the safer route, staying kind of somewhat defensive by going with an ETF, because you have a lower ATR, meaning if we would have had another whipsaw, the damage that would have happened would have been less. So we were kind of going in between, increasing exposure, but doing it in a kind of a slow and pokey type of way. So that was one area. And then the other one was through utilities. And the XLP.
We can start with XLU, the utilities, which here was the day, and it was following up on this reversal. So that looked pretty good.
Yeah, and then the XLP seemed like a lot of the stocks were in. Frankly, the XLP, and I think the two of us were talking about this earlier, the XLP looks better than the XLU at this point, and the KIE. And so lots of the money was rotating out of tech and into slower, pokier things. So this was a way for us to get exposure without taking on a tremendous amount of risk. And then the
was
defense
one more, the aerospace defense. Yeah. And this is also why I kind of, sent that alert out to folks, kind of letting people know, okay, this is our thinking right now. This is why we're putting them on, because it was in the last hour that we put, all of these on just as half positions, but it was really to kind of, again, make sure that our exposure didn't get too light, because in case it did, have a strong reversal, which it ended up really having a strong thrust. The NASDAQ composite. I'm just going to throw up I'll throw up a 30-minute chart here on the daily, and I'm sorry, on the intraday. And so you can kind of see, this was at 9:30. We were off the bottom. This was kind of when we were having our discussion, in here, but it was really a kind of a really strong move. After we put that stuff off, that this was the last bar there, the last 30-minute bar.
Yeah,
really
maybe
strong.
pull up SPY as well, because that was even more dramatic on the day.
Mm-hmm.
And and again, like you said, we were adding those before we knew that big bar was going to happen. That was very unusual. Probably did have something to do with the fact that it was the end of the month.
Right.
We've talked before about there's some weird things that happen the last day of the month, the first day of the month, same thing on a quarterly basis. It's a little bit magnified. But so that was unusual strength. And so I'm glad that we were able to, get back that exposure. And a lot of that was, your one comment there kind of just switched my thinking from defense to not necessarily aggressive offense, but getting us back in line closer to where we would want to be. And let's look at the SPY on a daily now. And with that big bar that we had on Friday, that's a significant line in the sand. So the bulls really stepped up and said, you know what, they're going to make a stand here. So that low on Friday, holding that, especially on a closing basis, is very important from any type of trading, from position trading or swing trading. And also what you want to keep in mind is when you're doing swing trading, that your stops by definition are going to be tighter than position trading. So they're going to be 2 to 4%, generally speaking. It does depend on how volatile the instrument that you're trading, but generally we try to keep it between 2 to 4%. With a position trade, that's more like 5 to 8%. So you have more wiggle room with position trading. Position trading, for those who don't know, it's just more, you're holding it for weeks, months, even longer, whereas swing trading, it's more days to weeks. That is the goal. So it's just
I would also say that one thing that I feel like with a position trading mentality, we tend to try and wait until the close, either the close of the day or a lot of times the close of the week. And for swing trading, sometimes you don't have that luxury. If you're taking too big of a loss, you really need to kind of cut that short. And so that was one of the dilemmas we were facing, on the swing trading side. That and Mike, you were saying this. You were saying, like, this is where, if the bulls are going to step up, this is where they should do it. And you were really wanting to hold on until the end of the day, but we just kept on hitting the stops. And so you're like, I don't want to keep on lowering the stops and just take on more and more risk. So we had to take some of those off. And again, it's one of the tricky parts about swing trading sometimes.
Yeah, we were pretty much forced into it because and this is helpful regardless if you take SwingTrader or leaderboard or anything, that when you're looking at trades, look at how the information you had at the time, when SPY was at the low of the day on Friday, what type of action should you be taking? And it really depends on your strategy. There is something to be said for waiting to the end of the month. There's people who do that, waiting to the end of the week, waiting to the end of the day. The longer you can wait, the more information you have, the better decisions you're going to make. But in the heat of the battle, if you're down at the lows and you don't take action there, and if we would have broken through the 50-day, which is your red line there, all sorts of algos would have kicked in and we would have gone a lot lower. And even if we would have still reversed, we would have gotten a lot lower and we would have been forced out at worse prices. So you do what you do.
I would also add that you have to keep in mind that, when you do wait for the close of the day, the week, the month, whatever your time frame is, if you're going to take a longer time frame, you have to be cognizant that you're also risking a bigger drawdown. You know, you a lot of times those reversals will come, and at the end of the, at the end of the day, the month, whatever, you're going to be like, oh, I'm so glad I hung in there because it came right back. But there are going to be those times when it doesn't come back, and you're going to take a bigger drawdown. And if you're following rules, you just have to know that that's the balance, that's the give and take of the different time frames.
Exactly. It just reminds me of a study I did years ago when I was creating the whole IPO based home study, and some sell signals around that. That was based off of a decisive break of the 50-day, as far as, or a 10-week line for to hold the stock. And I came up with how important it was for decisive, which is a whole topic for another day, that a decisive break, you had to wait until Friday. And doing the back test, it was phenomenal, the difference between waiting until the close on Friday versus acting on a Monday or a Tuesday intraday low, or even a Thursday intraday low. And, so in theory, works really well. And then when I was done with that, I remember I was trading this IPO, had a big position in it. And of course, it broke on Monday. And I was saying, oh, geez, I've got to wait until Friday. And boy, that was a long week. So it does, and it got worse. And I would have been better off selling it Monday than Friday. But when you've got a rule, you stick with it. And I did blow it out on Friday. The point is, whatever rules you're using, make sure that you know both sides of it, the good and the bad. So if you're waiting to the end of the day, exactly what Justin said, you can expect bigger drawdowns, fewer shakeouts. So how does that help you as a subscriber to SwingTrader, or just a swing trader in general? Maybe balance it out. And that's one of the things that we've talked about, the group here, the team of swing traders at IBD, is that we're going to try to, let's say we have a half position on, so a 5% position. Midday, when it triggers one of our stops, unless it's really bad, we're going to just trim half of that, meaning go from a 5% down to a 2.5%. And then we're going to wait until the final hour and then make the decision. Now, of course, if it's breaking wide open or it's making our loss too big, we're going to just have to blow out the whole thing midday. But that's one of the adjustments that we're going to be making. And it's something that we learned from Bill. He was always iterating. And that's something that Justin has always reminded me of, is Bill was iterating, in the 60s and the 70s and the 80s, all the way up to his retirement. And he changed dramatically. Like if you studied how he traded in 62 versus 82 versus 98, 99 versus 07 and so on, completely different person, different rules, same framework. And so that's what we'll be doing. Yeah, this is a good example that we can walk through the CPNG.
Yeah, so I was just going to show how some of these stocks that we were looking at, even though they did come back, and I actually didn't mean to change this on you, Mike. I was like, I thought I was on my other one. I have like a preview one, and I did the wrong one. But we might as well kind of move on to some of the individual stocks. This was when we were taking off Copang, and look, some of them didn't come back. And there was one that did. Our Bitcoin exposure, and I do have a position in IBIT myself. So yeah, this was one that did leave on Friday, but we ended up buying it back because it really kind of earned the right. So maybe talk a little bit about how you have to protect yourself from the Copangs, but you also have to make sure that you get the IBITs back.
Yeah, so I know a lot of people aren't comfortable selling something and buying something back. And I'm cognizant of that. And so that's one of the things we're trying to do is slow things down now a little bit. And that's one thing that we'll do in the short term for a swing trader. But I'm very comfortable selling something and buying something back. And if it doesn't work, selling it and buying it back again. That's my style. That's how I've always been wired. I don't care what's happened before that I was in it and I had a gain or a loss. And that's just something I learned from Bill. He just said he didn't care. And that just stuck with me. And how I'm wired. And I think that that's how, especially if you're swing trading, you have to be willing to buy something if you have a reason to buy it, sell something if you have a reason to sell it, and then be willing to buy it back. And like Ted Lasso said, be a goldfish and just forget about the past. Like, don't have a memory of that you just bought it and you locked in a great gain or a terrible loss. If it's set back up and you should buy it back. And one thing that he told me personally was, if you're going to buy something back, buy it back with a little bit more. And he meant like 10% more. Now, within the structure of swing trading product, we pretty much are just buying things at a full position, which is a 10%, which is what we did with IBIT, or 3/4, which is 7.5, a half, which is 5, or a quarter position, which is 2.5. So always be paying attention to those sizes, because that does mean something. And we are trying to make a statement with what size we're going with it. So we went with a full size here because if this is going to work, and I'm not a crypto guy, I'm very agnostic on the whole thing. I'm not pro or negative crypto. I'm just
like
looking. Yeah, I'm just looking at the chart. The chart looks right, and so we were given it a shot. And after we put it on, I bought it back in my personal account. And it looks like if it's going to work, this is where it should end up working out. So that's a long way of saying, don't be afraid to go and buy something right back that you just sold, regardless if you're swing trading, position trading, or anything in between.
Another thing to maybe chat a little bit about, because one of the other areas of strength that we saw on that Friday was medical. So we did put Vertex on, and that's working out nicely. Extended now. So for those of you that aren't on the Swing Trader product, it's a little bit late for this. It's when we put it on was much earlier. When the alert went out. So, but this is working. ISRG, I mean, that's one that we've struggled with a little bit, because it looks, set up, and like, think of it when it was at the high of this day, it was looking really good, like a breakout, but it does seem like it's kind of, struggling around that 400 level. And I should have mentioned, I do have a position in Vertex myself. And then NVO, we've kind of been,
let's go back to the ISRG just for a second, because this is one thing to keep in mind, that we were looking to put this back on today, and just being cognizant of the fact that we wanted to kind of have this talk first and let everybody know. And this is why we're doing this every Tuesday. So when you see all these alerts go out, that you understand, like, there's thinking behind it, what our thinking is. Are we going to be right all the time? No. We're going to be wrong all the time? No. But there's thought that goes into everything. And this one is back in position to be bought right here. Is it perfect? It's not perfect, because perfect would be if it was kind of wedging or drifting down. It's kind of flat, which is another form of a wedge, meaning you're not really shaking people out on the downside. Now you're wearing people out because it keeps on wanting to go and it doesn't go. But I think this is perfectly actionable if you're comfortable with, the fact that, it could just shake out below those areas that you mentioned before it's ready to go, if it even goes. But, we decided to hold off on adding this back because we'd been chopped up in it a little bit. And we want to get a little bit of cushion on other things before we start getting aggressive again. Now we can go back to the NVO, which I have a position in as well.
As do I.
After we put it on.
Yeah. And this is one that we actually initiated back on May 20th. And so this one has been held. So, yeah, so hard to get.
I know sometimes it's kind of tricky, but right there.
Yeah, that's the day right there. So, we did take some off. We got all the way up to 3/4. We did take some off on the 28th. That was this day right here. And, maybe that was just an exposure issue.
Yeah, lots of times we're making decisions based off of, we're always looking at how deep in the market are we? how much room do we have? And then there's this thing that I've always referred to as an SOF, or I just call it a source of funds, where if you've got something that is kind of dead money at the time or is risk money, that you can sell that to buy something else. So sometimes when you see us reducing a position, there might not be anything really wrong with it, but we just know that it could be dead money for a day, a week, couple of weeks. So we're going to sell that or reduce that to use it for something else. So at that point, it looked like it might handle out for some amount of time. We didn't know how much time. It just handled out for 2 or 3 days. But so we reduced it. But now this is back, and this is a full size position. You can walk through where we added those if you want.
Yeah, so we brought it back to 3/4 on this day. So again, we reduced down to a quarter that day. We had added it initially there, and I can't remember when we brought it to a 3/4. That was on the 23rd. Oh, I just erased those. So on the 23rd, right here, we put it to 3/4, took it off to a quarter, and then we were adding it back to 3/4, and then added to full on this day. So this is our only, I believe, our only full position on an individual stock. But
which is making it kind of a statement. And when you look at the positions that we have, they're quarter size positions and half size positions for basically everything. And with the exception of NVO and the IBIT. And unless I'm forgetting something, I don't have my sheet up. But we're making a statement with this, making it a full size position, because this is now in a standard place to buy it, regardless of your style. You could be a position trader or a swing trader or even a long-term trader, and this is where you're going to buy it. Does it mean it's going to work? No, you never know if something's going to work or not, but the odds are stacked, on our side with this one, because it's a clean breakout. So that's why we've made it a full position, and we'll see how it goes.
Mm-hmm. So to just kind of wrap up this session, we can kind of talk a little bit. And again, for those of you that are SwingTrader subscribers, you can always go to the platform and see all the individual stocks. But we're just going to talk in general right now about where we're at. And the miscellaneous you see is the biggest piece of the pie. That's our ETFs. So that does include, QLD and SPY, also the ETFs that we talked about. So technically, when we say insurance is 5%, really it's kind of 10% because we have the ITA. I'm sorry, not the ITA, the KIE that we mentioned earlier. But then you can also see that medical is getting quite a bit of exposure there. Retail is also quite a bit of exposure as well.
Yeah, so this is important to do with your own account, regardless of if you're taking SwingTrader or not. Always know your sector exposure. Then do a breakdown within if you're trading ETFs, and we just wanted to keep this simple, but then kind of know like what Justin was saying about the insurance. You're kind of doubled up there. So it's important to know if you're balanced or not. Now, you don't always have to be balanced, but if you're not going to be balanced, let's say you're all semiconductors, well, that's fine. There's nothing wrong with that, but you're just taking on a lot of individual group risks. So you just need to watch that very closely. Or let's say you're all leisure, all medical or retail. There's nothing wrong with that. That's not the style that I like to do, nor have for this product. I want it to be more spread out and diversified. That should help you when things aren't all correlating to one. When you have events like Friday, everything's coming down at the same time. I mean, almost everything is coming down. So those times, the diversification really doesn't help you. But in normal days, it will, because you'll have one group going up and maybe the other one is pausing or going down. And so that's just a general philosophy. And even though Bill O'Neill would be concentrated when he hadn't built up a single position that was a monster sized position. He tended to be spread out over different sectors, although it would only be maybe 5 or 8 different stocks and concentrated
But
in
he
one or
also
two.
did kind of change his tune, I would say, after 2008, the financial crisis. Wendy, a good friend of ours, was a
Yep.
portfolio manager at the time, and she was spread out. And and that was actually before the financial crisis really hit. This was more in March of '08 when we did have a little rally there, and he noted, hey, she's
And she
doing
had over
okay.
20 positions, which
Yes.
as a PM was a no-no,
Right,
like a big
exactly.
no-no.
But, she defended, her thinking, and it was working, which again, if it wasn't working, yeah, you can't really defend it, but it was working. And so, Bill gave that some serious thought, and it stuck with him, as we came out in 2009. And I would say for the next few years, he was starting to get a little bit more comfortable with having more stocks himself. And again, part of that could be that he was getting more conservative,
Mhm.
as he was getting older, and wanting to make sure he was, a little bit more protected, not quite the cowboy he was in his youth, but yeah, he definitely got more comfortable with that in those, I would say after 2008. The
Yeah,
last time I
totally
think
agree.
that I saw him really go that deep heavy was Apple and Google, in what was that, 2005, 2006?
Yeah, it was that
Around
time
there.
frame. So, because
Yeah.
all of us on the PM staff, we were pretty much 100% in those two stocks. I had 120% in Apple, 80% in Google, and I didn't sleep well that whole time.
Right. So,
That was crazy. But we
not for
were,
everybody. Yeah.
yeah, we were all that way. And then in hindsight, I looked at it because that's just how Bill was wired, and he was comfortable with that, and so he was comfortable with all of us on the PM staff doing that. But it doesn't allow you to trade a stock well, in my opinion. If you dial back down the position size and spread out more, you're more likely to handle the wiggles and wobbles, and that's why we're spread out. And we've got 2.5% positions, 5% positions, and our big position is a 10% position, which for Bill would have been a baby position. I don't hear you.
Well,
Do you
I
hear
was
me?
thinking that
Oh,
was
there you
probably
go.
a good place for us to exit out here,
Yeah.
and close it. We're trying not to make these too long, so we got shorter this time, but we're we're working on keeping these a decent length. But hope you guys enjoyed this, and we will see you next week. I did not realize I was muted. I was coughing, so thanks, Lily. But yeah, we will see you next week, and thanks a lot for joining us this time around.
Thank you.
Bye bye.